Good afternoon, ladies and gentlemen. If I can ask you all to come in and find a seat. We only get 40 minutes for this session, so we want to try and get it on as quickly as we can. Oh, dearie me. So I've been told that, I've been lectured, in fact, that I was supposed to have looked at the questions in the Hoover app in the earlier session. I didn't even know there was questions in the Hoover app, but now I do. But I just think, I can't find them. Have you posted one? Will somebody please post one so I can see if it's working? All right. So this session is on innovative financing models in healthcare, and we want to go through a whole range of aspects of it. And we're going to start off looking at how you can use innovative financing in order to enable small business. Businesses that can't get credit, businesses that can't get access to funding, businesses that can't buy inventory because they haven't got money. How do we enable those businesses? And then we're going to migrate it up the scale into bigger businesses that need big bits of capital and decent-sized lumps of investment. And then all the way up to, and what do you do if you happen to be a sovereign government? And you need to actually raise capital either for programmatic deployment or for infrastructural development. So we're going to go all the way up the scale. And we're going to start off with Vinod talking to us about MedSource and the business in Kenya and how they're using innovative financing in partnership with the Gates Foundation and the African Working Capital Fund in order to enable that operation. So, Vinod.
Thank you, Ian. Thank you, Ian. So, good afternoon, everyone. So MedSource started off around 5 years back, started trading around 3.5 years back. We started off as a GPO model, and from the GPO model, we found that in trying to create access of affordable, good quality medicines to patients in the last mile, access to credit, and hence access to the product was always an issue. So what we tried to do is create or remove the barrier of those last mile pharmacies, hospitals, clinics that are not able to access credit for various reasons. For various reasons, didn't have access to credit from either the distributors or the manufacturers themselves. So in knowing the problem, we tried creating a solution around this problem. So there's a whole member graduation journey that we're talking about now. When I say member graduation, we onboard small little pharmacies, little clinics, and little hospitals. Those don't have any capacity in terms of a group buying or large quantities of buying that they have. So those little ones or those small ones have the capacity to serve the community, have the capacity to grow, and have the capacity to expand the business as they serve the communities as well. So identifying the needs of what they would need so as to provide access of the good quality medicines, we started providing them, we started becoming a guarantor of the credit to the distributors. By that, what I mean is that we created a pool of cash paid of the distributors as soon as the order is placed on a platform. So it's an automated API that we have generated with one of the leading banks, Standard Chartered. So as soon as the customer places the order, once the distributor confirms that the goods are ready for shipment and are billed, the distributor is paid automatically on behalf of this customer, and hence the access of credit is taken care of. What we do beyond that or after that is another story. But yes, so credit is taken care of. With that, the member grows the business. They are able to service the community. The business has grown. Now he needs to graduate into the next journey. That's where the next capital fund comes in. And hence, this pool that comes in is now able to give larger credit to those pharmacies or clinics or hospitals that have grown beyond the capacity of what we would want to provide in terms of credit, and they graduate to the next step. Once that happens, so there's already a feel of what the customer or what the member would be able to get in terms of the credit. They now graduate on to the next journey of their life cycle into the commercial lenders. So we have created a whole history of a saga of learning for this customer right from a time when he was not able to get credit free of cost, to graduate into a credit term where he has a little bit that he has to pay for the credit, and then graduate finally to the commercial lender and hence grow the business. And in doing that, he has now created access to good quality, affordable medicines to patients in the last mile. So with that, I would like to stop here now.
Now we go one back, in fact. Oh. Ah. That's better. Right. So I'm going to ask the panel to join me, grab a chair, pull up a pew, and let's get on with it. And yes, the Hoover app is working, so if you're asking questions, put them in the app, and I promise I will remember to read them. Yeah? I'm going to start off chatting about, so what have you seen that works? What have you seen in the market? How does it work? How does it create that impact? And all the way up the scale. And I'm going to ask Maeve if you would go first and talk us a bit more about the structure behind the cash incentive, the cash model that Vinod's just been talking about in the African Working Capital Fund, and how it works, how you built it, and what it's going to do.
Thank you, Iain. So for those of you that don't know, the Bill and Melinda Gates Foundation is working on an African Working Capital Fund for distribution of health commodities. And it's for distributors and distribution partners. So that could basically be any of the logistics service providers or tech-enabled traditional distributors and pharmacies, or your traditional distributors and pharmacies as well. And it's in a pilot stage. Seems like everything I'm doing is in early stage. So it's currently in the design and pilot stage. And the intent here is the fund eventually would be like a $2 million fund that would be used for working capital. The phase it's in at the moment is a pilot phase to basically test out the fund structure and also the lending instruments. And the reason why we're doing this in a pilot phase is really because what they want to do in terms of like credit risk, risk assessment, and distribution is a little bit, or disbursement is a little bit different to how it would normally be done. And the other part of it as well is that it's initially funded by the Gates Foundation, but the intent that it would be scaled and other DFIs would also put money into the fund. And there's discussions around what that looks like at the moment and at what part of the pilot that they would get involved. But there's a lot of interest from the DFIs, which I think is important, and it sounds like it's something that is recognized as a need. I think the uniqueness of it is the fact that it is for a particular part of the supply chain, and that it is for health commodity, the health sector. And the other part of it that's a little bit unique is that it's going to have an impact component to it. So basically, the actors that are going to be benefiting from the different financial instruments will have to have commitments around, you know, where their distribution is going to be, not just in the urban areas, but also into more of the hard-to-reach areas. There's also going to be a focus in on the particular commodities that are being used, ensuring that, again, this working capital isn't just being used for the high-margin commodities, but rather as well is going to help to ensure the supply of the most essential ones, but that don't necessarily have a high margin. So there's a lot of different triggers on it. It's I think it's a very exciting project. I don't know, Iain, if you want me to talk about any other aspects of it at this point.
I think we can get to the other bits of it later on. I think the fact that it scales across multiple things, but it's also being limited to the stuff that nobody else is doing.
Exactly.
That's probably the most important part. It's about going into areas of risk and risk management that nobody else is going into. Nevilene, I'm going to come to you next, and I'm going to bring up your slide on social impact bonds, and just to talk a little bit. Well, first of all, explain what you're doing with SIB, Nevilene's actually a family practitioner, so she's not a finance person either. So
No.
has got into this. Explain a little bit about what you're doing with the Social Impact Bond with the Medical Research Council, but then also, as a little bit of a cynic on this, why is this one going to work? You know, we've been talking about SIBs for a long time. What makes you confident this one's going to be different?
Because I'm there. That's the simple answer. I think that I've moved from focusing on healthcare and program development to actually trying to realize that we need to make change. We can't continue doing what we're doing, right? It's not working. Change is not happening fast enough. We're spending lots of money, but the people at the end of the value chain, the patients, are not really seeing any difference. So what are we going to do differently? So the Medical Research Council has started a new focus on innovative finance. We started with a social impact bond, as we're calling it a learning SIB, because there's lots of learning to happen. Our thinking is that we need to bring in new ways of new forms of financing. We need to learn how to use the funds that we have more effectively. And we feel that the SIB structure allows the innovation that you need to develop programs, but also to test that they work, and also to bring in the flexibility that the SIB does. Because normally, a lot of these funders have programs where they fund a specific activity according to a standard operating procedure, but that does not fit into what the community wants. And often, it takes 3 or 6 months to change, and often there's not the capacity to reflect and take into consideration what the end user wants. Because I think the main thing is we keep on talking about what we want to see happen at a local level, but we're not really actually listening to what people are saying on the ground. So this methodology allows an implementer to actually listen and get feedback from stakeholders and make changes timeously. So the model of a SIB is really you use some form of investor who provides the upfront capital. Those investors can be any form of investors, right? And in different examples, there have been really different ones. What we've done is just chosen one investor to keep it simple, seeing as this is a learning SIB. They provide the upfront capital and they take the risk. Then you have implementation by an implementer, and only as you measure the results, the outcomes funding actually flows. So the outcome funding then starts to flow into the project and continues to fund the project. There are various versions of how this can happen, but obviously that's the one that we've chosen, and that's kind of the easiest model to implement. What you also have is an independent evaluator who is independently checking the results, so that when you're paying for a result, you are assured that that result has actually been achieved. And part of this is moving to a focus, we're trying to bring about a cultural change. A change where government thinks about outcomes rather than outputs. I should have mentioned actually that our SIB is actually, the outcomes funder is government, which is the first time in health. And we were quite amazed. It took us 2.5 years to get approval because the legal arrangements do not exist in our Public Finance Management Act. So we had to work very closely with Treasury. We had approval from all the ministers, Minister of Finance, Health, Basic Education, DSI. So we've really done a lot of homework to set the precedent and to get people on board. I think another important element of how we've approached it is to take a difficult social challenge. We're focusing on HIV and teenage pregnancy in adolescent girls and young women, where we've had some success over the years, but we've not been able to achieve the results that we need. And I think if you speak to people on the ground, they will be telling you that teenage pregnancy is our next COVID problem, kind of level of problem. People are not, they're seeing it only as a health problem, but it has a large and lasting social impact, and it continues to affect the country's ability to raise funds. I think the last thing I wanted to say is that while we're focusing on driving health outcomes, we're also aware that that's part of a bigger picture of social change and basically driving economic growth as well. So we're interested in working with the private sector to unlock impact investing opportunities, to say the Medical Research Council knows about the evidence of what works. We also have a close connection with government. So a lot of innovation that is being done is not being translated into knowledge, into policy, into change. And that's another particular role that we would like to play. And we're going to use this first SIB to build an ecosystem to drive that learning agenda. Thanks.
Thanks, Nevilene. You know, the movement of risk in the SIB model is one of the things that fascinates me about it, where the risk starts off entirely with the funder, the impact, the investment funder. But then there's a big risk taken up by the implementer as well, because if it doesn't work or they don't do it well, they don't get paid. And the risk to the outcomes funder is, if it works, they're on the hook. Yeah? And so you're able to transfer and move the risk as the model develops and as the model grows. We can get into the limitations a little bit later, but Silven, as you look at the spectrum that we're talking about here, all the way from small to medium to large enterprise, obviously from an IFC perspective, you've done the biggest deal in healthcare that's been done in Africa. I mean, you've played in the space from the bottom end to the top end. An interesting factor is the Transform Health Fund and what's been happening with that and what it means and what it's going to do in the space. Tell us a bit about it. Tell us about how you put it together, what the vision is, what the dream looks like, and then what you think the practical challenges are going to be in getting it done.
No, thanks, Iain, for having me today. I think when one sort of thinks about the impact investing space, I think putting out the statistics and the numbers out there is very critical. I think if you look at over 500 billion of investments that have been made in the impact investing space, of that, only about 1.6% has only been allocated towards health and health services impact investing. And I think if you think of it, of the overall disease burden right across the world, I think only about, 25% of that is found in Africa, while it's only 1% of global investment within health gets into the region. So I think it goes without saying the amount of the magnitude of the gap that we definitely have. And I think we from the IFC, having identified that, yes, whilst we do work right across the whole spectrum, with big pharma companies such as your Aspens and other big ones, but I think we have identified to say, look, if we are going to meet the challenge of impact investing, or rather of catalyzing health investments within the Africa space, is for us to look at models that can reach the bottom of the pyramid. Now, it's a model that is not certainly easy in many cases to fund and to find the right models that can act as aggregators. So hence why we came up, or we thought through, of looking at the Transform Health Fund, which we worked with our colleagues at Africa Invest. Yeah, it's a fund that is based out of Nairobi, Kenya, with I think about 4 funds. And our view is to look at models that are not only private equity driven, or return driven, but I think at models that have a combination, right, of both, outcomes driven, like Naveen was speaking of here, but also something that allows returns, to the commercial investors. And hence why we then came up with the Transform Health Fund. It's a debt fund, largely that is going to be looking at mid to low cap size health services businesses. So you're looking at pharma, you're looking at those within the whole spectrum or the value chain of health services, who will be looking for debt checks or equity debt checks or quasi debt checks of anything between $1 million to $2 million max. We are not going beyond that. And the idea is to set it up in such a way, or rather we have already done that it's a capital stake model, right? So at the bottom of it, you find that we have got investors who are coming in with grant money, right? And these are mainly your outcome-based investors who come in right at the bottom and say, look, what we are looking for return is not, your typical, bank return or interest or whatever, or coupon, but they're looking for outcome-based return, right? So these will be the ones that will sit right at the bottom, and they will provide your catalytic capital. Right on the top of it, you then have your commercial, investors. And the whole idea is to have the grant money, is to have the guys who are sitting at the bottom catalyze the returns for the commercial investors who typically are viewed to bring in the efficiencies in this model. So as IFC, it's a $100 million fund. We have mobilized about $60 million from our partners. From our own, we are putting anything between $15 and $20 million into that particular fund. And the whole idea is to say, look, can we use this as a start to catalyze investments right at the bottom of the pyramid? And in our view is if we do it in a fund model, then we believe we can get to reach the outcomes, but at the same time answer the key questions that most of the other commercial investors would have as they sit right on top of that capital stake. And I think as we do more of this in healthcare, we can get into other sectors where this can be done, in tourism and in other places as it were. Yeah.
Something that actually is just worth pointing out, Nevilene, even in the SIB, the implementing partner, that's anticipated to be private sector implementation. Yeah? Not in your one.
But I think it brings me to the question, right, Iain, and sorry to interrupt you, is to say, look, I come from a private sector background, so excuse me for this question, but really to say, to what extent then can we get the private sector playing a bigger role in SIBs, right? Because if you think of it from a numbers perspective, again, the sustainability-linked bonds have catalyzed over the couple of years over $500 billion in funding. But if you look at SIBs, I think they've only managed to catalyze less than about 500 million or so in many of the countries. And in many cases, SIBs have been designed more to attract philanthropy investors as opposed to private investors. So maybe my question to you, which maybe we can help answer this, to say, look, how can we get the private sector more involved in helping catalyze them to play within the SIB space?
Absolutely. I mean, I think in our engagement over quite a period of time with private investors, I think we need to build our understanding of what people are looking for. You need to give them a good understanding that the area that you're working in, that you have competence in that area. Because we spent a lot of time trying to explain that the Medical Research Council has R1 billion every year, and we have clean audits for 50 years, but people didn't quite believe that. So I think it's your competence. It's also the language and the understanding of working with different kinds of organizations. So a large part of what we want to do with changing the culture is sharing of data, the openness, the understanding, the passion where everybody is coming from. Because our investor will be making a return if we have success. We do also want investors to be the private sector to be the implementers. With our focus at this point, there are non-government organizations providing services in school. So we're trying to take healthcare actually to the school, to the coalface, directly engaging. But this model can be applied to private investors, absolutely. And in fact, I chair the oversight committee, the governance committee for this SIB. And I want to learn from the private investor how to drive performance. And you have interesting conversations, We'll say to the implementer, if you don't meet this, you'll have no more money to go further, And so that's an interesting point for the implementer as well. So definitely the model can be used in any kind of way. We definitely want investors not only to be part of the capital stack, but also to be part of the implementers to drive that efficiency in different parts where NGOs or government is not doing well in those areas. So let's admit things are not working and let's try something else.
The ability to get private sector capital in is not just about reducing the risk in the centerpiece, it's actually about offering a reward on the way out as well. So
That's
they're able to actually make a return.
We want to acknowledge that. Everybody wants to make money, right?
Yeah.
Are we with you?
I'm going to track us all the way back a bit, and cycle back out of the SIP conversation and go back to our small business again, right? Because it's an area that fascinates me. We talk about getting businesses into the space, and how do we get to those businesses that serve the bottom of the pyramid? And classically, the kind of business you're talking to doesn't have the ways and means by which to get normal capital. They don't have financial statements. They don't have assets to put up for security. And a big topic in that space is then about using proxies for credit. So, Vinod, if you talk about the proxy credit ratings that you've been looking at within MedSource, explain to folks, what does that mean? How does it work? What do you actually use?
So when I spoke before, I said we offer a guarantee on behalf of the pharmacies or the outlets for the supplier to be assured that he would be paid by us on behalf of the customer. So going by that, what we do is we kind of work with the trading history. So this is supply chain data working for the customer, for the industry, and trying to bring about a behavior change. And what I mean by that is if a customer has traded continually 2 times, 3 times, 4 times in a month and has paid for the first one within the same month and the second one within the same month and the third one by beginning of the next month, means there's already a trading history. So there's already a credit scoring that has been developed for that customer. So the banks probably would never get, because these are not the traditional kind of banking system where these guys are collecting cash and banking into a banking system and drawing for their own operational cost. They're using the same to fund their business as well as chew up the profit from within whatever they try to get. So what we've done is we have used supply chain data that we have in terms of the credit, the trading history, and given them a credit rating, and based on the credit rating and the number of days that they're able to pay, and increase the limit slowly by slowly so that he gets into the trend of getting the funds but also paying back in time, and incentivizing him to pay in time, as he also ensures that there is always an on-shelf availability. There's also price-to-patient compliance. So in doing that, we have taken care of the patient. We have taken care or tried to help him do the business better, and also provided the much-needed credit, which he needs to now cater for the patients in terms of keeping stocks on the shelf as well. So supply chain data for validation of his own creditworthiness is what we are looking at currently.
What other forms of proxy data have you seen used, and how do you just ran that great session on donor engagement? How do we get donor funding? There was this big workshop yesterday on private sector engagement by donors. How do we enable that? How do we actually bridge that divide between the great big bag of donor money and the tiny little business at the bottom of the pyramid?
Oh my God.
Finger on the buzzer.
Yeah, look, I mean, I think, first of all, to answer the second part of the question is that I think there is no silver bullet, but there's a lot of conversations and there's a lot of willingness and desire to bridge that gap. And I think that this pilot on the African working capital, and I think, even the stuff that's been done, Transform Help, the SIBs and all of that, all helps to inform the different types of, I think, financial instruments that can be made available. But I think on the other hand as well too, there's a lot of efforts just in terms of breaking down those contractual barriers between the bigger donor agencies and being able to to work more directly with the smaller organizations and help them to scale. I think, this is just sidelining for a second, but I think we have to remember, if you're a big donor agency and you're trying to make money available to multiple different organizations for whatever reasons, the transactional costs of those contracts are very high. So you're going to want to make that contract bigger and have a team of people around it. So the donors are not structured to give grants or investments or anything like that to smaller organizations, and they recognize that. But I think the more interesting piece for me is the question around, the data, the supply chain data. So one example I have that for me, for the last few years, I think has been just really innovative. And there's a startup organization called Parcel, and they have electronic sensors for monitoring the temperature of cold chain. And so what they have actually done is partnership with Lloyd's in London, to where Lloyd's is actually using that data to actually better understand where the risks on the cold chain actually exist, where the actual risks exist. And in having, excuse me, in having that visibility, they can then write the appropriate risk. They don't have to guess. And what was eye-opening for me is that in talking to Lloyd's and all of that, they said they never had that visibility because brokers kind of always kept them further apart. So I think a lot of insurance companies are now seeing these opportunities to leverage sensor data to actually better understand and to write risk. In terms of the African Working Capital Fund, one thing I didn't mention is that most of these organizations that are going to be able to access the working capital probably wouldn't have a robust credit rating with the usual banks. And it's not that they're not performing, it's just that they don't have the history, or the banks aren't interested because they're new businesses, or whatever, all the reasons Vinod talked about earlier. So the idea is that there will be due diligence done, and the supply chain data of their businesses, of their day-to-day transactions, will actually be used to help provide us types of patterns of behavior, to understand, where some of these risks do and don't exist. But the exciting thing about it is that in doing this through the African Working Capital Fund, the intent is that eventually the banks will say, hey, okay, we want to work with these companies. So then as they want to get bigger chunks of money, they can kind of move along that pathway. And I think even if you talk to a lot of the tech-enabled startups that are even here this week, the amount of information that they're able to get in terms of performance at the facility level, at the pharmacy level, or at the wholesaler, distributor level is so valuable in being able to create a new picture around performance and transactions. And I'm hoping that banks are actually going to start changing how they're reviewing their credit ratings, etc. as well.
And in that, not only do we get them to better support the business, but they then better support the business owner to buy a house or buy a car. Because the wholesaler that they used to build up a credit rating with is never going to buy them a car. So there's that migration path that you can do when you're using proxies and non-traditional instruments. Nevilene, the whole concept of outcomes-based that you went to just now is a really interesting one for me. It's because, the vast majority, you talk about private sector engagement, and Kofi and I were having this discussion last night about how do we get the private sector ready to be engaged. Everybody assumes we're just going to go out and go, private sector, and it's all going to work. It ain't, right? How do we get them ready? Because the traditional private sector is a transactional-based fee-for-service, pay me, I do the work, pay me now. Even getting them to understand capitation is a big step. Getting them to understand outcomes-based contracting and what they're going to need to understand to manage risk is a whole nother one. What are your thoughts on that? Who all are we going to have to, if we're going to get to outcomes-based funding, who all are we going to have to train? What skills are we going to have to develop? How are we going to have to change the way in which people do business in order to get outcomes-based contracting?
Well, I think that we are aware of the fact that it will take time, it will take effort, it will cost a bit of money, but we see it as worthwhile in the end. I think we certainly at the MRC are setting up a learning agenda and network where we will offer opportunities to investors to, we'll be doing things like webinars, information sheets regularly, updating them on what we're doing, what other SIBs and DIBs are happening in Africa, trying to provide specific information. But I think the main thing is going to be conversation. I think it's going to take time for people to understand each other, to build the necessary trust that people need to invest in understanding why they should focus on outcomes funds, and that they can still make a profit within those structures. I think that we offering also access to government and government thinking, because we really want government to be able to be a big outcomes funder. Because we're saying government is spending a lot of money, but they are diverse, they're not coordinated, they're not getting their bang for their buck, really. And so if we improve the efficiencies of government spending by focusing, by driving a focus on outcomes funding, when we bring the private investor, you can see the additive value of your money. You can be involved in different kinds of structures where you have an opportunity to not only get involved in the social change of a SIB or DIB, but also actually get a return on investment. But I think the main thing is that it's going to take time. We've got to start somewhere. We'll start the conversation, and also at the MRC, by doing a few of them, we actually learn a lot more, and then we spread the information. So,
and do you think there are fair benchmarks out there that we can use to set targets? Are there other countries that we're looking at in terms of seeing what targets are fair?
I mean, I think that lots of countries are trying various things, you know. I think the UK seems to be the most advanced in that way. We are actually part of a broader system with the Government Outcomes Lab to try and spread the information across the areas. There's certainly a lot out there, but it's gonna take time. And we're not under any illusions that you've got to try, demonstrate. We've also, in this SIB, focused on an impact evaluation as well as economic evaluation to try and answer those questions. Because at the moment, there are very few DIBs and SIBs focusing on health. So we want to be part of that learning curve. Thanks.
Yeah, and I'm going to interrupt you. I know you want to go to the next, and we're probably out of time. But I think on the point that she was making on how we can bring in the private sector to do a bit more. I mean, if I think of it from a funder's mindset, I think the structuring of the SIBs is critical, right? And I think, in my view, I think about 5 or so things definitely need to come into mind. I think number one, we need to make sure that the SIBs, as you go to private investors, it has to be priced in line with the market, right? Because, I mean, private investors are looking for something that can attract them or that they can compare with other, investment opportunities that are in the market, right? And secondly, liquidity is very key. So the instruments need to be structured in a way that they can be tradable, right? So if it's not going to be a tradable instrument that you're going to set, your ability to attract a pension fund or, say, a family office or whoever is going to be difficult. So I think we really need to ensure that the instruments and whatever we put together, it is structured. Then there also needs to be an aspect of principal protection, right? So if I put in $1 today, the issuer must make sure that at the end of it, there must be a level of protection, guarantee insurance that can at least give me the ability to get back that dollar and recycle my capital, right? Then I think fourthly, it is scale and size. What I've sort of observed is the fact that most of the SIBs are really of a small scale size, right? So I think it has to be scalable because smaller size transactions tend to be much costly to fund, right? So the greater the scale you create over a period of time, particularly in health, the lesser the costs then become over time. So I'm just trying to share some of these to say, look, from an investor's mindset, I think the structuring as we think of how we can scale up SIBs, how we can do more SIBs within our region, I think these aspects are going to be very critical and will attract better investors, yeah.
And then just looking back at the SIB, right, and we won't go to debt swap because we are out of time, but the use of a fourth party in philanthropy in order to dilute the capital cost in order to reduce the run-on burden of the capital cost. How easy do you think it's going to be to crowd philanthropy into a DIB/SIB type environment? Do you think that's got potential?
Certainly, it does, right? And I think that's the role, like we said. I always view, and I hope I got this question right, but I always view, the philanthropy capital always comes in at the back end of the capital stack, right? A SIB is not anyhow different from a capital stack approach. It always comes right at the bottom end, firstly to deal with the costs. But I think more importantly for me, it's also to help subsidize the returns that would go to the commercial investors who potentially could come into SIBs. And when we look at it, especially from the ISC perspective, that's how we sort of try to think of it, to say it should always come in as a third of us potentially getting, or doubling or trebling the capital that we can put in a particular fund. So philanthropy capital can come in, sitting at 30%, which can allow us to sort of, double up or treble the amount of capital that we can capitalize in. So it sits in as a first loss type of, capital. First loss from a return, first loss from a cost perspective. And I think when we do that, it then gives us the ability to not only invest the bottom of the pyramid, but go into other markets that are difficult, right? We are looking at markets such as, South Sudan, Ethiopia, countries that are more challenged, right, than some could find here in South Africa. So I think those are markets that with such type of structures, can we reach those particular markets to give them a chance to at least develop? Yeah.
So the clock has stopped, but we just need to finish off the conversation. I saw another Hoover flash. Oh, there's another one flash. Too late. Hopefully what this has shown you is that when we talk about private sector engagement, when we talk about doing things differently, there are many different ways to do things differently. And so we have to break our link in our heads to the classic, let's get a US government contract, and start thinking about very, very clever ways of actually getting money into the space. And what you've hopefully also seen is that, although I don't think anybody's used the word sustainability, but every single one of these models assumes a transition to a sustainable funding model. Yeah? And so, just as we finish off, respecting the fact that we stand between all these good people and their lunch, what final thoughts and comments on the use of innovative financing as a way in which to expand access to care? Rapid fire. You
I was waiting for this. So, in trying to create access to good quality medicines at affordable prices, I think in the pyramid, when you take care of cost of financing, reduce it, but also make it viable for the business to run, and hence ensure that throughout the transition, there is some kind of cost that is self-sustaining that has been built up in the business, and hence not being passed on to the patient, definitely will reduce the price to the patient. Knowing fully well that if the customer is paid the importer or a distributor, the distributor is paid the manufacturer gets stocks shipped out to the distributor in time, and hence the back cycle also works. So hence it definitely reduces cost when there is some catalytic funding or there is innovative financing that works in the ecosystem.
I would say two things. One, I think, is that we need more shared learnings across the different models because, and I think shared learning more real time because I think then we can continue to co-develop and change as we need to. I think the second thing is we're underestimating the value of the data that is already being collected out there and how that actually needs to break the current systems of providing credit. And last thing I will say is that I just think from the space we're working in, I think manufacturers need to get on and start just putting more credit into the supply chain because ultimately it's their business at the end of the day.
Thanks. I think the main point I'd like to say is that we are looking at a culture change here. We're looking at sharing of data, so people should get used to that. I think we're building accountability. We do want to build sustainability through being able to share the knowledge that we gain from here, and that important link to bringing government along with us, so that as you innovate, you are starting to prepare them for change and for that scale up is very important. So hence responding to your question about sustainability and acknowledging that it's not going to be easy, but does take time, but is possible. Thanks.
Thanks. I think from my perspective, Iain, I think we did not go through the debt swap arrangement where we can actually use some of our, governments, say in Africa, that or say states or countries in Europe, where they can actually use their debt obligations to potentially be moved. Instead of paying governments, they can possibly divert, those repayments towards, say, health or anything of that nature. I think that's one model where, like I think Naveen has said, we need to find a model where we can work with the public sector and the government to see what they have, and we can potentially try to convert that, to work in a big way, particularly for funding health. But I think from what we've spoken today, what I just wanted to also raise was the role of aggregators. I think aggregation models is what is going to give us the next leap in getting the ability not only to pull in capital, but reduce costs and reach the bottom of the pyramid, right? And I think that's a very critical aspect, that if we can focus on creating those aggregation models, I think, there's more that we can do. Then, of course, the role of technology. You were on an AI, panel earlier today, Iain, which was fantastic, by the way. I think there is a role that we can use the emerging technologies to see if they can help us, not only to create those aggregation models, but they can even help us to reach some of the bottom of the pyramid. I was going to talk about, a model in Kenya called MTIBA, which was launched by, Safaricom. And it essentially has got three pillars. It has got the aggregators, it has got, of course, the clinicians and physicians, then, of course, it has got the payers, who some are bottom of the pyramid. And when you aggregate these three, you can essentially create a model where cash and money can be followed, which in future can then be used even to own lend to some people who don't have credit history. So I think aggregation models and technology, there's a role that if we can combine those two, there's more that we can do. Thanks.
Hopefully you've had fun with this, and hopefully it's given you an idea of the fact that if we want to be increasingly relevant in our own industry, the skills we need for tomorrow are very different to the skills we have today. And the way we're approaching things as organizations need to change, because the order of magnitude of the challenge that lies before us is far greater than the money we've had available in the past. There's a lot more to do, and there's a lot more funding available if we open our eyes to the different ways in which to bring that capital to bear. Thank you very, very much for your time. I've really enjoyed it. It's been a great learning experience, as ever, and I hope you guys have had a bit of kick out of it as well. And please, if you just thank the panel for me, I'd be grateful. Cheers.